a question from a guy who was setting up a trust for some young children, and he was talking about the investing aspect of it, and I thought it would actually make a good video. When we invest, we often hear things about how do you invest, how do you diversify? Well, you can diversify within an area of the market. Like large U.S. stocks, you can diversify and own all of them. Or you can actually own the total market. Actually, that's a different type of a fund, but you're going to see how similar they are in just a second. Or you can really diversify by owning areas of the market that move in dissimilar fashion with each other, or they don't move in tandem with each other. So let's just dive into this and take a look at why somebody might be tempted to just put everything in the S&P 500 or a total market fund right now. S&P 500 is just going to own the 500 biggest companies. Total market might own like 3,600 companies. There's an index that actually tracks that. It's called the CRSP index. It's the Center for Research and Securities Prices 1 through 10. So that's what I'm using as a proxy for a total market. Now, what I want you to notice is over the last 10 years, you notice that large U.S. stocks as measured by the S&P 500, the blue line, and the green line, which is the total market, much higher returns than a totally diversified portfolio. Well, why? Well, because when I diversify, I'm going to own lots of different areas that move in dissimilar fashion with each other. And let's say if you have a period in time where large U.S. stocks has the highest returns, well, it will do better than diversification because that area did better than everything else. But if we look at 20-year periods, historically, look at 20-year periods, value stocks outperform growth stocks, which would be like the S&P 500, 96% of the time. Well, you hear I didn't say 100% of the time. So that's why we would own U.S. large stocks like the S&P 500. It would be part of a diversified portfolio, but you don't want it to be the total portfolio. Now, if we take a look at, let's say, from 1970 through 2024, it's a different story. If we look at a longer period of time, we see diversification being a much higher landing place than large U.S. stocks or a total market portfolio. But I just want you to notice something. How close a total market portfolio owning 3,600 companies is to the S&P 500. You almost can't distinguish between the lines. Why? Because most of the money in these portfolios are in the very largest of companies, so they will move historically very similarly. So you can see the level of diversification is showing up there. Even though you may own the total market, it's a problem. Now, if we look at the dead decade, let's look at 2000 through 2009, you see that large U.S. stocks and the S&P 500 both actually lost money over that period of time. So you can go long periods with no returns whatsoever. Now, you talk about discipline. It's hard to stay disciplined for a couple of years when you're not getting returns. Try staying disciplined for decades or, a decade or even decades. Now, the other thing to notice here is this, is if we look at that decade, we see that large U.S. stocks lost money. The whole market actually lost money, but an aggressive mix would have actually had a positive return because international stocks had done so much better, and small value stocks, which would be poorly represented in a total market portfolio, actually did quite well during that period of time. So that's why we want to be that diversified. Now, is this unusual? Well, that investors have this kind of a problem staying disciplined. No, actually it's not. Dalbar does research on investor behavior, and what they found is that the average asset allocation investor, that's somebody diversifying between large companies, small companies, and bonds and stocks and fixed income investments, actually had a rate of return that was pretty close to the inflation rate over the past 30 years. So you see that it is not unusual for investors to get pulled off track when it comes to investing or to be thrown off by short-term returns of one area of the market. We tend to focus on what's right in front of us, but as investors, we want to make sure that we stay diversified. They say don't put all your eggs in one basket. I want to expand that. Don't just eat eggs. Have everything in your investment portfolio. Hope this is a good tutorial for you on diversification.